Welcome everybody to the Jimmy Real Estate TV show. I have a very special guest here today. His name is Feliks Gitsin from Fort Funding. Can you explain to the viewers what Fort Funding is?
Sure, we're a mortgage brokerage here in New York City, but we're licensed in New York, New Jersey, Connecticut, Pennsylvania, Florida, and California most recently.
Perfect. And the reason for this video is to give value to every viewer out there who's confused on what's going on right now today in the real estate market. You're getting both sides of the stories out there. You're getting one side telling you that the market's great. You're getting another side telling you that there's going to be a crash. So I hope this video here and this interview with Feliks is going to clear things up for everybody and make you more comfortable on what's going on. And if you do have any questions at the end of the video, we'll talk about it more, and you can reach out to Feliks or you can reach out to me, whoever you have a question for, and we'd be happy to help you out. So let's get this interview started. So we're gonna start asking you, Feliks. We're gonna ask you questions about the current conditions. I'm gonna read some questions that people asked me to ask you, and just tell us what it is.
Sure.
So I want to ask you. So I want to include what we're going to talk about today is the current conditions for people looking to get mortgages. People include first-time home buyers, secondary home buyers, which is vacation homes, investment buyers, 203K loans, which is all only primary, I believe.
Yes, but there's also a different type of a 203K loan. It's called a Fannie Mae home style loan.
Okay.
That allows primary buyers, secondary home buyers, and investors to purchase a property. And it's a conventional loan that has a renovation component, along other proprietary products that banks offer.
Perfect. Mortgage interest rates, I saw it rose back up above 5% on Thursday from 4.99%. Now it's at 5.22% on 30-year loans as of August 11th.
Right, that's based on Freddie Mac's averages. But keep in mind, no matter which way the rates go on a week-by-week basis, we are definitely in a rate increasing environment. So that means chances are 3, 4, 6 months from now, rates will probably be higher than they are today.
Gotcha. Okay. So I wanted to ask you, because we are getting two sides of the story here, one from the mainstream side and one from independent, real estate experts out there, like on YouTube, TikTok, whatever it is. One side is saying the market's going to be okay, and the other side saying there's going to be a crash. So before we get into anything else, I want to ask what your opinion is on that.
All right. Well, overall, the market crashing, that's not a realistic expectation based on today's qualifying standards for mortgages. Back in 2008, it was a whole completely different story. We call that in the mortgage industry the cowboy days. Banks did products that they didn't explain to customers correctly. They didn't verify documentation. They didn't verify income, assets. Literally, if you had a pulse and a credit score, you can get a loan. Those were the cowboy days, and that's what caused the collapse in 2008. Right now, for the most part, in order to get a loan, you have to verify your income, you have to verify your assets, you have to source and document where the money came from, you have to have a good credit history and a good employment history. The income has to be stable. If it's not stable, so for people that are, for example, nurses that are going now traveling the country, traveling nurses, that's variable income. You have to have a 2-year history of doing that. So the qualification standards are much more rigorous, and they're meant to basically not have that issue that we had in 2008. Now, don't get me wrong. There's other programs that are available in the market called non-QM lending. That's similar to stuff that we had in 2008, but it's not 106% financing like we had. Somebody has to put typically 20+% down. They have to document an alternative means of paying back. So for somebody that's self-employed, we would have to show 12 to 24 month bank statement history for either their personal account or their business account to document the deposits and averaging those out to create a different type of income qualification. So those programs still have a premise on the consumer's ability to repay. And since they do have some sort of qualification for ability to repay, alongside with larger down payment requirements, those are significantly safer than a normal mortgage would be. Back then, you had the government subsidizing people giving Fannie Mae loans with stated income. You don't have that anymore. Fannie Mae, Freddie Mac, FHA, and VA loans, which are all government backed and for the most part are 90+% of the mortgages out there, are all full income check documentation loans with verified income, assets, and credit, and those are performing excellently in this market.
Gotcha. Okay. Well, that's what I was going to ask you next. Compared to the last few years, I was going to ask how strict are banks being with giving out loans, like back in 2008. But like you said, they're being strict now. The only thing that could be a risk is what you just said. What was the name of that again?
It's called non-QM lending, so not qualified mortgages. So
Gotcha.
after 2008, the federal government came into place with different acts, and one of them was the ability to repay rule.
Okay.
So banks, in order to give a loan to somebody, they had to document that they could qualify how they could pay back that mortgage.
Gotcha.
Where before, stated income, you didn't have to do that.
Okay.
And those are regular conventional loans. Non-qualified mortgages are loans that don't have to adhere to that rule under standard terms, so they show it a different way to pay back a loan. Whether that's for an investment property, debt service coverage would mean that as long as the rent covers the mortgage, okay, that's one way you can pay back the loan. That makes sense.
Yeah.
That's a debt service coverage loan. Bank statement cash flow loan, which is 12 to 24 months personal or business bank statements. We see deposits coming in, we see activity, okay, you're able to pay your bills based on your credit, you get a loan too. If you have a ton of assets, you cover the loan for the next 5-10 years, that's one way you can pay back the loan.
Okay. So there is protection.
There is protection. But those are not, the key here is those are not supported through the government. So now you don't have a situation where institutional lenders, big banks, are giving those loans and the government's bailing them out. They're not provided by institutional lenders. They're provided by intermediary lenders like hedge funds and stuff like that. Okay. Bankers, not banks.
So it's safer, basically.
It's safer and there's less exposure to it.
Okay. So is there anything from that would cause a housing collapse, like they're saying, or?
Remember, housing collapse is everybody not paying their mortgage all at once. Listen, realistically, can it happen? Sure. But the problem here is we have a lack of inventory. We have people that need to buy a house. Mm-hmm. We have people that can't afford to buy a house because of rates going up and causing rents to go up. So in terms of the housing market collapsing, it's very difficult when the alternative is renting, and renting is very, very expensive. You need a place to live. So short of tenants not paying their rents and people not paying their mortgage and a complete economic collapse, it's unrealistic. We're going to have bigger problems than worrying about real estate if that happens.
Yeah. Now, speaking of the mortgages, of people not paying, during COVID, a lot of people had a chance to not pay their mortgage, right?
It's called forbearance, yes.
Forbearance, and they were able to they were given an option to pay a lump sum, I believe, after a while.
So forbearance, it's different on the program in the bank, but in general, forbearance for the conventional loan, they gave people, at first it was 6 months of, hey, you could pay us later, and they would throw it onto the back end of the mortgage. Mm-hmm. So basically, let's say you had a mortgage for $100,000, and just to make things simpler, your payment was $500 a month. If it's 5 months that passed, now you're $100,000. You still owe that $100,000, but on top of that, they gave you $2,500 that they put on the side that you owe them at the end of the loan. It's a non-interest bearing account, so it just sits there.
Now, just to ask you, there weren't any lump sum banks were saying you had to pay a lump sum. We're not going to put it on the back end of the loan.
So you could pay it up front and catch up and call it a day, but realistically, almost nobody did that. I mean, if you're expecting people not to be able to pay, they're not going to be able to magically come up with 6 months worth of mortgage payments out of the blue. So nobody really did that, or very few in my experience. So realistically, it was just all in the back end,
Gotcha.
Which they will have to pay at the end. So when they sell, they're going to have to pay or refinance.
So you didn't hear of anything where there was banks out there not accepting people on the back end?
For standard loans, no. Again, every case is different because there's old mortgages out there that are not standard government-backed mortgages.
Okay.
For those loans, every case might be different. But you got to understand, most loans out there are Fannie Mae, Freddie Mac, or FHA loans. And for those that want a forbearance, the rules are pretty clear. For off-the-beaten-path mortgages, anything can happen.
Okay. All right. That's good to know. Now, also, do you feel it's a good time for people to start buying right now?
Okay, so right now the market has slowed down. I'm sure you've heard in the news, listings are sitting there. Prices actually in many markets have started to come down. So the fact the market has slowed down is a good thing for potential buyers. Think about it. 6 months ago, if you wanted to put an offer on a house, oftentimes you'd have to go at asking, above asking, or get into a bidding war. That's completely slowed down. Now there's properties that have been sitting in the market that you can negotiate. You go under asking price. Still, properties that are in excellent condition, move-in ready, are still going pretty quickly. So it's not that the brakes have been hit on the real estate market. It's just that buyers are now becoming more selective and realizing that, hey, rates are up, costs are up. Let's take a step back and assess what our affordability level is. The way I run my business and the way I think the consumers are, when you're purchasing a piece of real estate, everybody asks, when is the best time to buy, right? Guess what? That was yesterday. You can't buy yesterday anymore. So either you wait till tomorrow or you buy today, and guess what? Today will be yesterday tomorrow.
Okay.
So real estate in general in the United States consistently has been going up in a 10-year cycle. Every 10 years, it's more expensive than it was 10 years ago. Okay? Even when there's downturns, eventually it levels off and real estate goes up. So you're not going to find the best time to buy. And if you're in the market right now, it's a good time to buy simply because, yes, rates are high, but that means there's less competition. You're able to take a little bit more time to find the property. You could even negotiate the terms of your offer. And you don't have to give up a lot of these contingencies. A lot of people are buying houses without inspections or waiving appraisal contingencies. I personally think that's nuts. But people were doing it because they were just trying to jump over each other to get a house. That's not happening anymore. So you know what? For the buyer, the market has now become favorable for them. Mm-hmm. And that's an opportunity that you may not have in the future, because if you wait for rates to come down, and in my opinion, they will come down eventually once inflation's in check, guess what's going to happen? Oh, rates are down. Everybody that didn't buy, now all of a sudden is going to start buying again, and you're going to be back into the bidding war type of situation.
Yep.
And so, yes, can real estate drop? Absolutely. There could be a little bit of a downturn. Property values go down a little bit. But guess what? Eventually they're going to be higher. And if you're going to wait for the rates to come down, that's when they're going to start getting higher. So if you get into it today, you lock in today's prices. And then when rates come down, you could always refinance. So I think it's a great time for a buyer to buy. You don't have to deal with everybody else.
True. Now, we're talking right now about primary residences for buyers that are looking for primary. Now, do you feel, is it a good time for investors to purchase? For investors out there looking to buy?
So that's a good question. I mean, rents, like I mentioned, are all-time highs across many markets in the United States. So for an investor perspective, that's great. However, this is already built into a lot of prices. And rents being this high has to do with remote work as well. It's really going to depend on what happens with remote work. If it becomes a thing that sticks, then realistically, rental prices in big cities are going to start coming down. Because if you don't have to be in New York City to work in New York City, the reason people work here and live here is so they could work here, get the salaries here, enjoy the lifestyle. And if we see remote work really become a permanent thing, I feel people will go to cheaper parts of the country, like they have already with Texas, certain parts of Florida, and metropolitan areas will get affected for investors. I think it's a good opportunity for people outside of the metro area. If you're buying investment properties in tertiary cities, you might be able to have a good opportunity there. But the rates are high, so you got to understand that right now, investment cap rates are not great because rates are high and property values are high. So going into something based on appreciation is one thing, but based on actual numbers where, hey, am I going to make money off my investment today? It's not a great time to be an investor. If you think the market's going to get better and you want to let it ride, as they say in Atlantic City, you let it ride and eventually you may come up ahead.
Yeah, well, that's possible. I do understand what you're talking about with the cap rates. They're not high right now at all. But we're talking about New York, and it's possible it's happening across the country since the rents are high everywhere. Also, I wanted to bring back where you said the interest rates, it's possible that they're going to come back down in the future, but you don't mean anytime soon.
So let's be clear about this. When COVID happened, the rates in the twos that occurred due to the Federal Reserve really pumping money into the economy is probably not going to happen again in our lifetimes, okay? So I don't mean rates are going to come back down to the twos. But historically, rates from 2009 till 2020 prior to COVID, realistically, in general, fluctuated between 3.5% and 4.5%. Since they started really doing tapering in 2008 or 2009 to re-stimulate the economy to when they started pulling it back, generally that's when the rates really lined up. I do think that rates will come down. I think actually it might be in as little as 2 years. So a lot of market experts are saying that in 2023, the Fed's going to have to pump the brakes on their increasing interest rates and may even have to go the other direction. Because by doing this so hard so quickly, they're doing the right thing to curb inflation. And hopefully they get that job done sooner than later. Mm-hmm. But inflation's hard. Inflation's a nail, right? So think of a nail sticking out of a piece of wood. If you slam it down, it'll go down quick, which is what they're trying to do. But you're going to damage the wood, and the wood's our economy. Mm-hmm. So when the economy gets damaged, they're going to have to prop it up again and bring us back a little bit. And so market experts are estimating that in 2023, we actually might see rates start coming in. Do I know if that's going to happen? Absolutely not. But I do think at some time in the future, we will see rates coming back in to probably the levels of where they were from 2008 to 2020, generally fluctuating around there.
Gotcha. Well, thank you for all that information. I have another question for you. There's many buyers out there looking to get into the investment side of things. Mm-hmm. Even like first-time buyers, they didn't buy a house yet. They want to get into the investments because they're seeing all these videos, all these articles about investing, invest with me, blah, blah, blah. Are there any programs out there for conventional loans or people with low down payment, nothing crazy? Are there any programs out there for investors?
So typically the low down payment programs, the 3.5%, the 5% down programs are for primary residences. Mm-hmm. However, there are non-standard qualified mortgages, the non-QM loans that we spoke about, that are a little bit more lax. You could do 15 to 20% down, mm-hmm. depending on the bank, the program, but it's not for the first-time investor either. Mm-hmm. Remember, those mortgages, because they're riskier, they're not qualified, they come with a rate that's comparable to that risk. Mm-hmm. So the rate's a lot higher. So if you're doing an investment in a market where property values are high and now the rate's even higher, from an investment perspective, it's going to be very difficult for you to invest wisely. A lot of people are doing the whole Airbnb thing, but remember, Airbnb is popular because people can't or couldn't leave the border as much, right? Eventually, people are going to, from a New York perspective, keep this in mind, people are going to be, I don't want to go to the Poconos anymore, let's go to Italy. Mm-hmm. And then your Airbnb is going to be in trouble when that happens. People are going to get tired of driving for the weekend. They're going to want to get out and escape. Yep. From an investment perspective, just if you find the right investment, just be careful. You can get a good investment property with good returns. You just have to make sure you know what you're looking for and buying a property based on numbers, not based on something that could potentially not be there in the future.
Yep, perfectly said. Now, there's also many buyers out there. They're not sure of the programs that are available to them, and I figured you'd be happy to let us all know what kind of programs are out there for FHA, conventional, 203K,
So, Jimmy, back to what you were saying earlier, how lending has changed. So lending's actually getting a little bit more strict now. Okay. So conventional recently tightened up their guidelines. So for people that are with higher credit scores, they're not really going to be impacted by this. But the lower credit score borrowers with dings here and there in their credit are going to see that they're no longer qualified for conventional. So while they're still technically within the guide, so there's like a rule book that we call it's the guidelines. While they're technically still within the guidelines, What ends up happening is all conventional loans are typically automated, or most of them, and we run it through an automated underwriting system. And if there's too many risk factors based on proprietary data that the agencies use, Fannie Mae and Freddie Mac, it will reject them. Recently, I just had a 640 credit score person with 40% down. Conventional wouldn't take it.
Wow.
Yeah. I had another one with a 670 credit score with 5% down. Conventional wouldn't take it. So for those type of customers, conventional is getting a lot harder to get. And they're going to end up falling into the pool of FHA.
Gotcha.
So conventional is a type of mortgage program that's better for people with high credit, especially in the first-time homebuyer programs. They allow within 3% down, or a standard conventional primary residence program with 5% down. But that's meant for people with the top tier credits. If your credit is a little bit iffy, FHA is going to be the best program for you. The rates are actually cheaper on an FHA, but the payment's going to be a little bit higher because the PMI is more expensive.
PMI is?
Good question. So PMI, anytime you put less than 20% down, typically the bank wants you to insure the difference. So on a conventional loan, it's called PMI. On an FHA loan, it's called MIP. At the end of the day, it's the same thing. It's insurance to cover the difference, right? Conventional PMI is based on your credit scores, and it's from 780 down. Every 20 points makes a little bit of a difference. The higher the credit, the cheaper it is. FHA PMI is not based on your credit scores. It's based on the size of the loan, the down payment that you're putting down, and based on that, it gives you a flat rate to insure the loan. So for the lower tier borrowers, so somebody that has okay credit and below, FHA is a lot cheaper than a conventional loan would be. Conventional is a lot more expensive. So those are two programs for a primary residence purchase.
Now, I want to talk about the savings. People that are having trouble with the inflation right now, the high prices for everything, literally everything, almost. I want to ask you, what do people have to do in order to save the money up to put that down payment down on a house? For example, like car leases, things like that. A lot of people aren't allowed to make their debt to income ratio too high.
Okay.
So if you have any
So let's talk about
tips.
do's and don'ts in a mortgage. Okay, do's and don'ts in a mortgage. First of all, when it comes to somebody buying a house, right, you're going to need to have a certain down payment. For first-time home buyers, minimum down payment is going to be 3% down. Okay, on a conventional loan, 3.5% on an FHA loan. You do also have to save up for closing costs. Depending on your market, closing costs can be not so expensive, or they could be expensive. In Connecticut, for example, closing costs are very cheap compared to what they are in New York, which is some of the highest closing costs in the country. Welcome to New York. So you do have to save enough for that. So from a Staten Island perspective or a Brooklyn perspective, being in New York City, let's say you put 3% down on a conventional purchase here in Staten Island, your typical closing costs on a Staten Island transaction are going to be another 4 to 5% on top of that. So this is money that you typically have to get saved up. Now in this market, because of where we are, you may be able to negotiate a deal with a seller where they would cover part of your closing costs, or maybe even all your closing costs. It's going to be difficult, but if you find the right house, and you find a house that maybe has been sitting in the market for over 60 days, you can negotiate saying, hey, listen, this is a $600,000 house. I see that's what you're asking for it. No problem. I'll give you the $600,000, but give me a $20,000 credit to cover my closing costs. And the seller may say yes, and now all of a sudden all you have to do is come up with whatever the down payment is plus the small difference in closing costs instead of the full down payment and closing costs. That's a good way for you to be able to get into a house with less money out of your pocket, because $10,000 on a mortgage is not a lot of money. A $10,000 on a 5% mortgage is something like $50-something a month. It's not going to make a difference for you, but $10,000 out of pocket is. Mm-hmm. So that's a good way for you to be able to do things when you're on a budget. You'd finance it in and be able to get a house that's a little bit cheaper. There's tons of programs out there that are for low to moderate income buyers. And there's more that's going to be coming out. Fannie Mae and Freddie Mac are really trying to motivate first-time buyers, especially with those who are low income, to be able to buy stuff. So there's incentives, there's grants, there's programs that are available. So things on the horizon are better for the first-time home buyer than they were before.
Now, the only thing I think could be a problem I want to ask you, though, is that the prices, home prices, are very high. Income for many people is pretty low
Absolutely.
compared to the home prices. So, what are you seeing right now out there? Income wise, of the people getting the loans, people not getting the loans. In terms of like, let's for example, New York.
So we're seeing affordability across the board in every state that we work with being questioned. Real estate is really at a point to where it's no longer affordable, and a lot of people are getting priced out. But as a consumer, you have to realize, hey, listen, I can drive a beat up Toyota and be perfectly happy with it and make it nice, or I could get a Lexus that's brand new off the lot. The problem is when rates are where they are, the Lexus is no longer affordable. See, they have to really separate the needs and the wants when they buy a house. Mm-hmm. There's certain things you need. There's certain things you want. You might not get everything that you want, but as long as you get everything that you need, you could always buy the house that's cheaper to get those needs. And then in a few years, when you build up some equity, sell it and get the house with all the wants as well. Mm-hmm. And a lot of people don't realize that. They try to go for the house that hits all the boxes. You can't do that in this market. The rates are too high, the prices are too high. So the only thing that's going to have to give is the thing that is in your control, and you're going to have to give up some of those wants. So if you have 2 kids and you want a 3rd bedroom, you don't need a 3rd bedroom. You could get away with a 2-bedroom house, typically cheaper than a 3-bedroom house.
Gotcha. Okay. Well, thank you for everything. Everybody, this is Feliks Gitsin. How do you say?
Feliks Gitsin, yeah.
Feliks Gitsin from Fort Funding. Anybody that needs help with mortgages, have any questions with mortgages, or even any concerns, you can reach out to Feliks. I'll put his information down in the description box below. You can give him a call or send him an email, whatever he tells me after the show, what he prefers. And then also on the next interview that I'm going to have, we're going to do some house hacking where people are going to find out how others are living for free.
Oh, I've heard about that.
And that's going to be the next interview. But I'd love to let everybody know that this man is probably one of the smartest men I've ever met, and with real estate and mortgages. So I do recommend that you reach out to him if you have any questions. Do you have any last words?
No, I appreciate the opportunity for me to be here. And more importantly, it's really for the consumer, for you guys to have an opportunity to learn, because the more you learn, the better ability you have to make the best decisions for you and your family and figure out what the right path is. So don't think of this as anything but we're trying to help you make the right decision for yourselves. If you could take a little bit of the information, apply it to your life, our job is done, and we're very, very happy to be here.
That's it. We just want to educate. We want to give you something worth of value, valuable insight on what's going on today and what's going to happen in the future. And we really hope you like this video. Please hit the like button, subscribe, comment down below. If you have any questions, you can comment down below as well. And that's about it for today. I appreciate it, Feliks. Thank you.
Thank you so much for having me here.
Good seeing you again. And that's it, guys. Have a great day.